Hello, everyone, and welcome back for another edition of the Money Pros. I'm Oliver Tutt, certified financial planner practitioner, and your host for the next half hour as we talk about the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. The fiscal cliff, we can add it to the list of expressions from 2012 that we'd likely like to leave behind. While we didn't get the grand bargain many had hoped for, Congress was able to come to a last-minute agreement and avert a plunge. On today's show, we'll look at that agreement, better known as the American Taxpayer Relief Act of 2012, or ATRA, and what it means for you. Joining us, we have the experts, Karen Del Ponte, attorney and partner with Cameron & Middleman, Greg Piccaro, CPA and partner with Otranda Piccaro & Associates, and up first, Russ Towers, Vice President of Business and Estate Planning and attorney with Broker Service Marketing Group, joining us once again on the show. Russ, welcome back.
It's great to be back, Oliver.
Russ, we just spent before the show talking about a bunch of these provisions. We're still trying to get our arms around a lot of this stuff, but let's go through what we know so people that are watching can get a better handle on how this is going to impact their taxes for 2013. President Obama staked a big part of his campaign on the idea of raising taxes for upper incomes. There was some debate as to what exactly upper incomes was. As a result of ATRA, what decisions were made with respect to income tax rates for 2013?
Well, income tax brackets are finally permanent. We had the possible sunset of those brackets, the so-called Bush tax cuts. And all of the brackets are made permanent up to the 35% bracket. But now, added above that is a 39.6% income tax bracket for so-called high earners. In fact, that was the highest bracket way back in the 1990s in the Clinton years.
And how did they end up defining that highest, that 39.5 bracket?
Well, that's defined as high earners as married people with taxable income of $450,000 or more, or single individuals with taxable income of $400,000 or more. That will put them into that highest bracket, and of course, more of their income will be subject to taxes. So issues come up and planning issues come up because of that higher bracket.
But that's ultimately where the President and Congress ended up drawing the line with respect to high income earners, saying we're going to leave everything else the same for folks below that $450,000 level. But that's where we're going to mark the increase in income tax rates.
That's exactly right. So when you think about this at its most basic level, most of the Bush tax cuts, as they termed them, are still in place permanently,
right? Exactly.
Except for that new 39.6% bracket for these high earners.
Now, income tax rates was not the only thing that was affected in brackets with respect to ATRA. Another agreement was reached on how investment taxes were going to be treated. Chiefly, we're talking about dividends and capital gains here. What's going on with those rates?
Well, of course, under prior tax law and under the so-called Bush tax cuts from 2003, dividends were taxed at only 15% and capital gains were taxed at only 15%. But of course, that was again supposed to sunset on December 31st, but because of ATRA, we now have a permanent extension of the 15% tax bracket for dividends and the 15% tax bracket for capital gains. Again, however, we have created a new capital gains and dividends tax bracket for high earners. And the threshold amount is exactly the same as ordinary income. $450,000 married on taxable income and a taxable income of $400,000 single. What will happen in that situation is that there will be an additional 5% tax on capital gains and dividends. So in other words, those high earners will pay a 20% rate on capital gains and for qualified dividends.
So if you got clipped by that higher income tax bracket level at 39.5, you're also now eligible for that new investment tax rate of 20% on capital gains.
Yeah, and it depends on, of course, the makeup of your income. Some people, of course, will have earned income from salary and bonuses, and of course, those same people may or may not have investment income from capital gains and dividends. So you really have to take a look at an individual's total financial picture to see how the total effect of the taxes will work.
Now, one of the other big attributes of ATRA was addressing estate taxes, gift taxes, generation skipping taxes, things that we generally call estate and gift taxes. We're going to talk about this more in the second segment with Karen, but can you just briefly illustrate for us what happened with the expiration of some of the sunsets with respect to the tax exemptions on estate and gift taxes?
Well, in 2011 and 2012, what we basically had is a $5 million unified estate and gift tax exemption for single people and a $10 million unified estate and gift tax exemption for married. That was scheduled to sunset on December 31st.
And go back to?
And go back to the rate from 2001, where the exemption was only $1 million with a top estate tax rate of 55%. Of course, that was averted by the American Taxpayer Relief Act, and basically what we have now is a permanent extension of the $5 million lifetime gift exemption and the $5 million estate tax exemption.
So just a few seconds left. Let me let you get the last word in on this. What do you think some of these changes are going to do to the appeal of tax-favored investment products, annuities, qualified plans, cash value life insurance in some circumstances? What do you think the impact is going to be here for some people?
I think you're going to see many people whose combined tax brackets are going to start to shift upward, especially successful business owners and professionals. And what you may see them doing is shifting even more into tax-favored products, like the tax-deferred nature of non-qualified annuities, like the tax-deferred nature of cash value life insurance, where you can get your basis out of your cash value tax-free.
Because that tax deferral or tax-free nature has now become that much more valuable,
more
right?
attractive. The higher your tax bracket, the more favorable tax-deferred or tax-free investments.
All right, Russ, I'm going to hold you there. I know we're going to spend a lot of time dissecting this. If you'd like to know more information on the American Taxpayer Relief Act, please visit our website at foxprovidence.com. Click on the Money Pros. Up next, we'll take a detailed look at the estate planning implications of ATRA with our estate planning pro, Karen Del Ponte, attorney and partner with Cameron & Middleman. So stay with us. We'll be right back right here on the Money Pros.